and I've got like literally 1 or 2 minutes left with an appointment, and then I will be back to join you guys. Okay, welcome. I want to welcome Kathy Vitale and Tammy Mills with Shelter Home Mortgage. Can you guys hear me okay?
I can hear you.
Oh, hang on. I got something else going on in the...
You want to talk to Zilla? Great. I want to talk to him too. Let's do this together. You're on the same team.
Okay.
So you've got Tammy on too.
Yep. So we have Tammy and Kathy. I emailed you guys about an hour and a half ago a Mortgage 101 handbook, basically. It's got a series of questions and answers. And Tammy and Kathy are going to spend some time going through those right now. And I will be back in 1 or 2 minutes. And then I also want to spend, if you guys can carve out a couple of moments towards the end, maybe so our PC people can get to know you a little bit better, and your backgrounds and your history. Maybe you could start with that. If everyone's on their best behavior, Kathy, maybe we'll share some old pictures from us knowing each other 30 years ago. And I also want to make sure that people know just more about you guys so that they can support your business. Okay. And we'll do some Q&A too. So the floor is yours. I will be back in 2 or 3 minutes. Okay.
Hi, everyone. Can you hear me? Sounds good? Okay, good. Tammy and I are so excited. I told Bill the other day, I said, with all the Zoom stuff going on and not seeing you in the office, like, what can we do? And he goes, oh my gosh, I've got an opening on Friday you could fill. And this class that we're going to go over is normally a 3-hour CE class. So we're going to Zoom through it. And what we did for y'all is we went ahead and gave you all the answers. So you'll have everything already filled in. And that way you can just kind of take personal notes as you go along. For those that we haven't met, I am Kathy Vitale. I have been the alliance partner here for 14 years at Keller. I've been in the business 37, almost 38 years, and just love getting people in homes. Tammy Mills, who we'll talk in a second, is my business partner, and Tammy and I have been together now for, gosh, I think 10 years. I'm trying to remember, but around that time frame. And she'll tell you a little about herself. I am a mom, and I'm a grandmom. So that's kind of the big personal thing. And then Bill and I will talk later about how our history goes back to when he was a teenager. I'm a lot older than Bill. Let me put it that way. He was a kid back then. Tammy, you want to tell them a little about yourself?
Absolutely. Can you guys hear me okay?
Yes.
Okay, wonderful. So yes, I have been in the industry for over 25 years, and probably here with Kathy has been the best part of it for sure. We work very much alike. We're extremely passionate about what we do, especially with, working with, being able to work one-on-one with you guys and being able to be there to support. So it's great. It's weird, this new world that we live in, but I'm so happy that we have the ability and the platform to still be able to do this kind of thing for sure. Let's see. I too am a mom, 3 daughters, and recently now also a grandmother. I have a little 3-month-old grandson named Liam, which I just love and adore. So, but yep. And I think that's kind of where I'm at.
Yeah. Has everyone got the template open so you can see it?
No.
Yeah. So what we're going to do is skim through it because like it does have the answers. If you'll look at this first page, it's the mortgage history. We're not going to read through that. Good information for you, but no reason for us to read to you, the history of the mortgage industry, and which takes us to page, what is this page? I can't see it. Hold on. I think it's page 2. So on page 2, that's when it starts getting into what you really need to know a little bit about, starting with the features. The loan amount limit. Everyone here is conforming, conventional versus jumbo. This tells you right now that limit for this year. So if someone is getting a loan and their loan amount is above the 510,400 here in Atlanta, they're $1, above that, they're having to get a jumbo loan. So that's that cutoff. And then it shows you the 2 unit, the 3 unit, the 4 unit. Right now with our company, the minimum credit score for a conventional loan or any loan is 620. You're going to hear different numbers out there during the pandemic. At one point we were 640 and a lot of lenders are still at 640. So if you're talking to clients and they get turned down because they have below a 640, definitely let them talk to us. Something that we do is credit enhancement, and we'll talk about that a little bit later. If they come in below a 620 score, we can, our company does an algorithm and it's free off their credit report. It tells them what to do to get it up to a 620. So we give them a plan around it. Minimum down payment is generally 5%, but they can do 3%. There's different caveats for first-time home buyers and for people rebuying. And once we do the consultation and know that maybe the cash needs to be 3%, we're going to look at all those options with them. Not having private mortgage insurance, you're generally going to have to put down 20%. But and a little bit later, we're going to talk about how you can get rid of it without 20% on the loan to value of down. Let's see. I don't think we need to go through the balloon stuff because no one's really doing balloon loans or ARMs anymore. Talking about the mortgage company and the PMI, again, nothing big for y'all to know about. The seller can pay up to 3% of closing costs if the person of the sale, so you take the sales price, 3% of that toward closing costs, prepaids, and escrows, if the person is putting less than 10% down. If they're putting 10% down or more, the seller can pay 6% of the sales price, unless it's an investment property and then they're capped at 2%. You're never going to need that 6%. You're probably not even going to need the 3%. So be very careful when you're making offers that you know what the lender's closing costs are, you know what the prepaids and escrows are, because you never want to leave money on the table. If you negotiate the seller paying too much money, you get to the closing table and it can't go toward anything, the seller just gets to keep it. So you really want to know the loan that the client's doing and how much costs are really involved with purchasing that home. And we consult with our clients and our buyer's agents completely, very detailed on the specific home to make sure they know exact numbers. Dropping PMI is not easy, but it can be done. So let's say someone buys a house this month, they put 5% down, they just keep making their payments. When it gets naturally to 78%, because of the amount that's going toward principal when they make their payment, which it'll take a while, the PMI is going to drop off. A lot of people are going, well, what happens if I want it off earlier? Well, then they're going to have to wait at least 2 years. They're going to have to pay them perfectly, and they're going to have 25% of equity. So what happens is they're going to pay for a new appraisal at that time after 2 years. They're, of course, going to have the perfect pay history. If the appraisal goes up, because you've got appreciation with the property, plus they've been doing some principal reduction, then they could have the monthly PMI gone. Tammy, you want to start go over FHA? Any questions right now?
Yeah, my question was, they'd have to have 25% equity?
Yeah, then it goes up to 25% versus 20, exactly. Okay. Exactly. And you guys feel to stop us, ask any question in the middle. This is real casual, not formal. We want you, while you're reading and seeing this, we of course can always follow up later, but just stop us.
Okay, just to clarify something earlier, I may have missed part of it, but can you review the limits on seller concessions, and is it dependent on the type of loan or just the down payment?
Right. So we just went over that, and we're going to send a sheet after this. We actually have a cheat sheet on seller concessions and closing costs, and we'll get that over to y'all. I can probably email it while Tammy's talking. But Bill, we just went over on a conventional loan that if it's less than 10% down, it's a 3% seller concession, less at 10% or more, 6, investment property 2. But they don't need that much normally. So to check with us on closing costs, prepaids, and escrows, so we're not leaving it on the table with the seller.
What about FHA?
We're about to go over FHA. That's next.
All right, I'm just going to keep my mouth shut.
Tammy's on. You're good.
I love it. All right, so let's talk about the Federal Housing Administration loan. So this is a loan that's insured by the government, but the source of the money is obviously going to come from the lender. So let's chat about this particular product. As you can see, as you scroll down, it's great for the first-time home buyers. The maximum loan limits on this are actually really good. In the Metro Atlanta area, you can get a loan amount up to 401,350. And then as you can see, the breakdown, 2-unit, 3-unit, and 4-unit is also acceptable. So if you've got a first-time home buyer who's looking to also have some rental income, this is a great particular program for them that could possibly work.
Do you guys want me to give you permission to share the screen, or can I help you in some way with sharing the screen?
Well, we actually asked them if they had it.
Because we're not seeing what you're talking about.
Oh, okay. I thought
okay.
this was sent out to you
y'all were
guys.
opening up your own. Yeah, Bill, how do I share the screen?
Yeah, let me
Right
give you
here.
let me give you permission. Hang on.
Host, yeah.
I'm gonna make you a co-host, and Tammy, I'll do the same for you. So you should now have the ability to share your screen. Everyone has a hard copy, but it was sent out via email.
All right, I am screen number 3. Can everybody see it now?
Yes.
Okay, wonderful. Kathy, will you kind of scroll down as I chat about it?
Yep.
Okay, wonderful. So I was just right there where you see the maximum loan limits. So it breaks down 1, 2, 3, and 4 units. It'll give you the maximum amount for the FHA financing. Now there's been one change with the pandemic. The minimum credit score on this one is also 620 at this time for us. Now that does change per lender, but for us right now, we are at a 620 minimum credit score for FHA. So what does that look like as far as a down payment? That means the buyer can go in with 3.5%. There is the mortgage insurance premium that works a little bit different than conventional. There's an upfront premium that gets financed into the loan. So if you've looked at a FHA loan exhibit in regards to the contract, those are those questions that would be answered. Upfront is 1.75%. And like I said, it does get financed into the loan. Now, the FHA mortgage insurance premium does stay attached to the loan if they go with the minimum 3.5%. They would eventually have to refinance out of this particular loan to remove the mortgage insurance. One thing to consider, if they put a minimum of 10% down, still utilizing FHA for whatever reason, if they needed to, based on a previous housing history, say a short sale or foreclosure or a bankruptcy, then if they still go with 10% down, that mortgage insurance can be removed down the line. The nice thing about this one is, again, different from conventional. The seller can actually pay up to 6% of the closing costs. Again, not to exceed the actual closing costs in prepaid. So it's important if, let's say, your buyer can go in with the minimum 3.5% down, it's important that you have that breakdown before you ask. Similar to what Kathy said, you don't want to have anything left on the table. This is one where we allow co-signers, which is a great thing. So we take a co-signer and they can help assist with the qualifying. You don't have to run a separate owner-occupied ratio. It is a total combined. At this point with the pandemic, the debt to income ratios also has kind of been dropped. It's more conservative. So we're going to be looking at less than 50 or possibly even 45, depending on the overall credit score.
I have a question.
Yeah.
So with the co-signing, are they co-signing because of credit or are they co-signing because of finances?
It could be both or either.
Okay.
So if they're looking to qualify overall debt to income ratio and they need the income, it could be that. Now we do take the lower of the credit score. So it's important they both have to meet minimum credit score requirements.
Okay.
Okay. Now student loans, the way that's been working is that on FHA, they conservatively take 1% of the balance in the payment. So let's say they've got a $50,000 balance on a student loan. They've got to qualify with a $500 payment. And that's how that works. Even if they're in a repayment plan based on their income, it's important that we have to, as upfront, make sure that we utilize the higher payment so that there's no issues as far as qualifying.
Yeah, and even now during the pandemic, everybody's in forbearance. We still have to count a payment against them.
Correct. Yep. So we use our same appraisers, but they are also licensed to do FHA appraisals as well. So we have our in-house appraisals that do both.
So an
particular-
FHA appraisal can be used for a conventional loan. Let's say a person's going FHA, something changes, it's a condo and it can't get approved FHA. We can use that for a conventional loan, but you can't use a conventional appraisal for an FHA loan.
And if an FHA appraisal is completed on a property, it sticks with it for 6 months.
Right.
So we've had it where, let's say the property has fallen out and now we've got a new buyer and they want to utilize FHA financing, but an appraisal's already been done. It's important that those questions be asked during negotiations, just to make sure that there wasn't a low appraisal and that's what possibly made the numbers not work. So just things to think about. Let's see, limitations. I guess we can kind of, you can read that. I'm just trying to see if there's anything there that's of importance.
It doesn't say anything about it, but FHA does still have a flip. It may say later, I can't remember. So you have to be very careful. If it's an FHA contract, you need to make sure that you look at when the seller got the property. Let's say it's an investor flip and they bought the house 60 days ago. They're going to have to wait another 30 days, so 91 days before they can write a contract on that house and let that borrower go with purchasing that house if it's an FHA loan. So that's an FHA, yeah.
Same thing with condo. So if they're looking to purchase a condo and utilizing FHA financing, that condo already has to be FHA approved. And we have the ability to look that up. So if you guys ever needed that, we can give you the link and show you exactly how to look that up. All right.
And that link is available. That's on the HUD site, right?
Yeah,
Correct.
you can go on, you can go on HUD.gov yourself and do the drop down for references, resources, and it has the condo list, and you can just put the zip code in and see which condos are already approved in the area. Now, even though they say they're approved, we do have to get updated data to make sure it still meets certain criteria. But that's a good start, Pam.
Yep. Yeah, even if you Google FHA condo approval, it'll bring it right up.
Yeah.
Yeah, the engine is pretty smart that way. VA is another great loan for our veterans. So again, the VA guarantees the loan, but again, the lender is the source of the money. This one allows 100% financing for the veteran. And if the veteran receives any type of disability income, then they don't have to worry about the upfront MI premium, which is nice. And VA works off the same conventional loan limits. So it's great as far as this one will allow you to go up to 510 400. If it exceeds that, then they are going to need a down payment, and usually that down payment is roughly 25% down. It's
25% though above the 510 400. So you actually, let's say that the sales price is 550. You take the 550 minus the 510 400, and they only have to put 25% down of that difference. So it's really not a lot of money. I mean, you can do $1 million home on jumbo, and the calculations, you know, are not 25% of the whole sales price. It's just off the difference between the 510 400 and whatever the sales price is. And we, of course, would do all those calculations.
Yeah, same thing with this minimum credit score. Again, some lenders will take as low as 560, but with the pandemic, we're conservatively still at 620. This VA funding fee, if they're not exempt from paying it, then if they're first-time users, it's a little bit less. It's 2.3%, and it does get financed into the loan. So it's not anything that they have to worry about bringing in additional to closing. Now, the veteran can use their eligibility over and over, but they can only have one at any given time. So let's say they buy their first home utilizing their VA eligibility, and they want to go ahead and sell and buy a new one. They can do that. They can also do same-day closings. We've done that before, but they're going to pay a little bit more on that funding fee. As you can see, it goes up to 3.6%. Okay. No prepayment penalty. Now, the difference in closing costs on this one is the seller can only pay up to 4% of total closing costs and prepaids. we will ask for the veteran to provide a copy of their DD-214, and we'll pull the certificate of eligibility for them. And then this particular product is assumable only by spouse if the after death of the veteran. Limitations. So the VA appraisal works a little bit different. We actually have to order it directly from the VA portal. They then get the appraiser. Now, the one thing to take into consideration is that we can't necessarily rush this. It's done through their process. So if you've got a VA appraisal or contingency timeframe that you're looking at or financing in regards to this as well, you want to make sure you conservatively give yourself enough time. You don't want to do a 7-day or 12-day type program on this one. You want to give them some time as far as the contingency. The veteran is always going to be the first borrower on this contract, so it should be the first also on your contract, your purchase contract, because they're going to be the first on the loan. So everything's got to match. Their name has to read as their certificate of eligibility, and the co-signer can only be the spouse on this one, where the FHA doesn't necessarily have to be. And a termite letter is always required. So FHA, it is not, unless they were to see, active activity. But in this case, on a VA, we always require clear termite.
Yeah, it's the only loan that's mandatory. All other loans, they're going to wait and see if the contract requires it. So this is a key too. If your buyer says, I want a termite letter, and they negotiate it, we're going to ask you where that termite letter is. We're going to want to see it. But on VA, you have to have it. No other loan requires it unless you put it in the contract or the appraiser sees something to call for it. So you'll know that, the appraisal. USDA.
And I would just say real quickly on that note is once the home passes due diligence, I would say get it ordered. We've had some where they wait to the very end. It's like, listen, let's move this along because you don't want to be waiting on clear termite 1 or 2 days before.
Right.
Is it good just to do this just as a good rule of thumb, whether it requires it or not, just to be on the safe end? And is there additional fees for doing it?
For the
You
termite
mean asking
letter?
for the termite letter?
For the termite. Mm-hmm.
Pam or Bill, y'all answer that one.
I think
I just put it in the chat because, go ahead, Bill.
If I heard that correctly, basically, should we order a termite just in case? That would be something that I would encourage all buyers to have a termite inspection during the due diligence period. Typically, the cost on that is somewhere around $45 to $50. And I would encourage your buyers to do that. Oftentimes, if the property itself has a termite bond on it, then that termite company would come out and provide that letter oftentimes for free. But the home inspector, they may say something like, hey, you might want to get that checked if they see something worthy of concern. But I always recommend an independent termite inspection. I know I'd make that recommendation in writing to your buyers so that they can do that during the due diligence period. But from a lending standpoint,
there is a GAR special step for it.
Exactly. Thank you, Pam. From a lending standpoint, it's a requirement of the VA loan only. So a clear termite letter is not a requirement of the closing attorney or the lender unless it's VA. But from an inspection standpoint, you want to get that done.
Good information. So the next program is USDA. USDA is 100% financing. It does have mortgage insurance. It is different. It says 620 credit score. I'm going to look at that. USDA may have taken that up, but let's just go with 620 now. It's 100% financing. It's in a rural area, and I'll kind of give y'all, because of where we are, if you go north on 400 to Cumming, there's 20 that cuts across Forsyth County. Y'all know where I'm talking about? Most of the houses for rural housing are above 20. So if you live on the south side of 20 across the street, you can't do rural housing. But if you're above 20 on the other side of the street, north, it usually is. And it's just like we were saying about the HUD.gov, you can go on USDA and you can actually have a research of property type in the address, and it'll immediately let you know if it's USDA or not. You can do that, or we can do that. So if we have someone that needs 100% financing right now, that's the only 100% financing that we have available. I'm not sure about other lenders, but right now that's the only 100% we have available. It follows generally FHA rules and guidelines. It's a little more stricter, but not that much. It does have income limits, but most people buying 100% are in those limits, and we're going to look at their income to make those calculations. And it actually gives you the websites to look it up for income and for location. The next is non-conforming jumbo. And a lot of these numbers, again, this was a class that was created and updated last year or the beginning of this year. So the pandemic has changed some of this. Anything like we said above $510,400 is a jumbo loan. Rates are very competitive. I actually quoted a jumbo refinance today at 3% with no points. So it's very competitive. Conforming loans and FHA or VA are a little bit lower, but not that much. The minimum credit score right now because of the pandemic is 700. So they have to have at least a 700 score. If they go above $1 million in loan amount, the score even goes up, I think like 720, 740, that range. But again, when we're talking to clients, we're going to consult with them and look at the most recent guidelines and make sure that they know what those are. Maximum debt ratio is 43%. This SMART series in parentheses is not available right now. It hasn't come back. It got taken away. In fact, all of the subprime lending got taken away during the pandemic. Appraisals take a little bit longer because they have to go through a full review. There's actually a certification done that's a special process that it goes through to review. And normally on every loan, at least, I think the minimum is 6 months reserves required. So what that means is they're purchasing a home and we'll take their principal and interest, taxes and insurance payment and HOA, because they have to make that payment, of course, to qualify, but they also have to have 6 months of that in reserves. The reserves could be in a retirement account or 401k, but they've got to have that payment to fall back on to buy that house. Portfolio, can't do those now. Non-QM, can't do those now. Pandemic took them away. Looking at ratios and thinking about primary residency, your smallest down payment is going to be conforming, FHA, VA, USDA. The rate's going to be the best. Second home, you've got to put at least 10% down. And it really does have to be a second home. This is going to be a vacation home that's not where you live now. I have done one where they live here in Roswell and they buy a lake home, or they live here in Roswell and they buy an in-town condo. It's going to take 10% down. They cannot have the caveat that they're going to rent it out at all, though, in any type of rental. If they're doing investment property right now, it's going to be at least 20% down. There is a 15% down with private mortgage insurance, but it's really high, so most investors won't go that way. And they do get a better rate if they put 25% down. So if the rate is 3%, let's say, or 2.5%, let's say 3% right now on a regular conventional loan, that investor is going to at least get 3.75 to 4%. It's going to be a higher rate depending on their credit score. Credit score is really important on investment loans too. Fixed rate mortgages, of course, are what most people are wanting right now, especially they're so low. We've looked at recently some 10-year amortizations or 20-year. They're not as popular. The rate doesn't change. The 15-year is going to be the most popular right now for people refinancing and purchasing if they can, because they can get down to like 2.5, 2 5/8 on a 15-year. Let's see, mortgage terms for someone who'll have a mortgage long term. The adjustable rates really don't make sense at all. Definitely a fixed rate. So we're not even going to go over adjustable rates because nobody's doing them, but you can read that later. Not worried about the hybrid arm. Piggyback loans. We can still do piggyback loans. What that means is the down payment, and most popular is somebody will have 10% down. If they didn't put more down, they'd be a jumbo. And right now with us, jumbo is 20% down. So what we're going to do is a 10, 15, or 20% equity line attached to their 10% down and get them to the conforming loan limit. So it's called a piggyback, a combination loan. And we'll, of course, consult with them on what that looks like and what the payments are and what the closing costs are. Lender paid PMI. This is what I was talking about earlier. If you don't put 20% down, you're going to have PMI unless you get into the piggyback loan, doing a combination loan to get that full 20%, or you do LPMI. LPMI is lender paid. We are putting the private mortgage insurance into the rate. So instead of a 3% rate, they may get a 3.5% rate or a 3 5/8 rate, but then the private mortgage insurance is gone. So it really depends on that person's time frame in the house and what they need the structure to be. And of course, we'll consult with them on both, but it can be done. PMI can be gone without 20% down. Interest-only loans, those are on equity lines only. There's no first mortgages interest-only right now. Let's see, mortgage history, y'all can read all that later. Let's don't worry about that. Tammy, you want to start talking about the loan estimate and the closing disclosure?
Okay, yeah. So the loan estimate is the replacement of truth in lending and the good faith estimate, which if you're new to the business, you won't even know that that even existed. So your thought process is going to be, what does the lender send out initially to the client as far as giving them some numbers that are pretty close to, or going to be pretty close to the final numbers. So what it's called a loan estimate. It has to be sent out 3 days from the date of the application, and it goes out with the lender's initial disclosure package. And like I said, it's going to be a breakdown based on sales price. It'll give them their interest rate. It'll talk about the different fees from the lender, from the attorney, as well as the Georgia State intangible tax fees. So that loan estimate then is what they're going to kind of base their information, is what they're going to need at the table. Of course, it'll change, because if you land up getting some more funds, say credit from the seller towards closing costs, all of those numbers are going to be changed on what's called the closing disclosure, the CD. You'll hear that a lot. Now the CD requirement, the same thing, it has to go out 3 days prior to the loan closing. Now we actually have a great little tool, and Kathy, we should send that out. When is the CD due? Because obviously you got to take out weekends,
okay.
You got to take out Sundays. So we'll send that out to you. It's a great little tool that tells you exactly when your CD needs to go out, so that you're on top of making sure that your time frame for closing does not get affected if for some reason the lender misses that. Closing disclosure replaces, again, the HUD-1 settlement statement. Again, if you're new to the business, you may not have any idea what that is, and no need to, but what you're going to keep in mind is the closing disclosure is going to break down all of the final figures. Now, of course, industry-wide, there is a lot of volume right now. So our initial closing disclosure may go out, and it may not be the actual final, and that's okay. The key is to get the clock ticking, and the loan officer having open dialogue with the buyer, letting them know, hey, here's your initial closing disclosure, but let's talk about the actual numbers are going to be finalized once we get the attorney. Sometimes the attorney may be waiting for an HOA letter. So in that aspect, those kind of things will come in enough time to give the buyer enough time to wire their funds required at closing. And again, wired funds are by Georgia law, anything over $5,000 must be wired, but some attorneys actually require over $1,000 must be wired. So those are things that, again, you and the lender will make sure that the buyer is aware of. Okay.
And the closing disclosure is for the buyer only. It's not for the seller. So if you're on the listing side and you want to know the seller's number, you're going to have to reach out to the attorney and get an actual settlement statement for the seller.
Yep. So let's talk briefly, what's the difference between a pre-qualification and pre-approval? So a lot of times you've got to be very important, especially if you're on the listing side, when you're accepting offers or reviewing offers with the seller, is that if a letter is provided with their initial offer, you read it. Sometimes the pre-qualification is going to be very vague. It'll simply state that they've only pulled credit and that they haven't yet verified documents. A pre-approval letter is going to hold a lot more weight, and it's actually going to state that they've reviewed documents, credit, assets. And again, you as the listing agent have has the right. Again, it depends on the particular loan officer. They may or not give you information, but they could at least tell you what they verified and if they're a strong buyer. It's just one extra step to make sure that there's going to be no hiccups for you as the listing agent and your seller, to know that, okay, this is a solid, offer. I think it's a great one. If you're on the buyer side, once your buyer has been pre-approved for us, Kathy and I are pretty much identical in our system. What we do is we talk to their we do the full consultation. We'll issue a pre-approval or pre-qualification letter. Just depends. Sometimes if they're self-employed, we won't do either until we have income verified. It's important that we look at their tax returns to make sure what their net income looks like. But if they're W-2 and they're solid and we can do a verification, third-party verification fairly quickly, then a lot of times we can issue a pre-approval letter within the same day. So that's a nice feature, and we will send that pre-approval letter out to the buyer as well as you, along with the closing cost worksheet, which is going to be very similar to their loan estimate as far as the numbers that they can expect at closing, as well as also list what they can ask in negotiation from the seller for any closing costs. Once you get that pre-approval letter and breakdown, you're off and running. We always say, please, especially even now, I know not so many folks are getting in the same car, but in a sense, don't waste your time unless your buyer has been pre-approved. They may talk a big game, but at the end of the day, until you actually know that they've had a full consultation with the loan officer, it'll be just to your advantage to just know we're good. All right.
Now, a lot of the listing agents we're seeing they want a pre-approval letter, not just a pre-qualification letter. And what Tammy and I do is we offer to call the listing agent. So you're putting your offer in, it's multiple offers. We'll call the listing agent, introduce ourselves, tell them about our company. There's a lot of good things about our company compared to others, especially if it's an internet lender. Make them more comfortable with the fact that we've done a full pre-approval. We've looked at their pay stubs. We've looked at their W-2s. We've got their credit in. We've ran automated underwriting. We know that this client is solid, and we definitely help pull contracts together doing that.
I cannot stress how important that is. Have the buyer's lender call the listing agent.
Yeah, we've gone up and beat all cash offers because of it.
Yep.
Especially with it being a seller's market right now. Have your buyers, one additional step, write that letter, pull on the heartstrings. That, I can't tell you how many times that has also, that along with our call, they're willing to take that.
Yeah,
they like that.
Some of you don't know us or our company, but we, because of the 20-something plus years, 30-something plus years in the business, we can tell them that. We're also local, so our underwriting is local. Jumbo's a little bit different, but conforming, it's local. FHAVA, local underwriter. We have a local closing department. We have a team that's completely connected, proactively. And our appraisers are the best. If it's a metro Atlanta, now if you start getting out in the rural areas, it is a little different. But if it is a normal area for us, our appraisers are local. And they promise us, if there's any concern with that appraisal, that they're going to call the listing agent and the buyer's agent and say, hey, having a little concern here, can you help me out? That is huge if the listing agent can hear that. That conversation alone with local underwriting and the pre-approval, if it's a side-by-side offer and this other person is, just pre-qualified and let's say Quicken whatever internet loan, our offer will win, I guarantee you.
Guys, make sure you heard that correctly. That is a big, big deal. Big deal.
We have a lot of the listing agents that we've worked with a very long time, like Veronica Barish and others. that they will not accept a pre-qualification letter unless we've pre-qualified the person also. So on behalf of the seller, we do a pre-qualification. A lot of times we can win the deal and they go with us once they talk to us because we're very thorough, and a lot of times it'll help. But some of the listing agents in this office and others, they won't even take a lender that they don't know. They want us to make sure that this person really is pre-qualified.
Yeah, and then once you've got that contract, you know, we're off and running. So while you're doing due diligence, you know, that time period, we're now able to secure the interest rate. We're now able to send out that loan estimate for them to e-sign. A lot of things are done just like in your world, electronically signed. So that stuff gets out. A part of that package is what's called the intent to proceed, which I'm sure you might have heard in some of your classes. Basically, we cannot order an appraisal until the buyer has given us their intent to proceed by signing our disclosure. Once they do that, then that gives us the green light for us to go ahead and order the appraisal. Now, similar to the inspection
Tammy
cost.
and I have an advantage. I just had a situation with that. Tammy and I have an advantage. As soon as we lock in the loan and it's locked in through our secondary market, we actually disclose ourselves. So we can lock in and we can disclose that day and be ahead of the game with other lenders. I just talked to another lender that's a dear friend of mine. They have to wait for their disclosure department to send it out. So once a customer locks in the loan, it may take 3 days for them to even get the intent to proceed e-signed. So you've lost 3 days just waiting for a disclosure department. You don't have that with us.
Yeah, especially now with that being, as you guys know, appraisals are taking a lot longer with the amount of volume that the industry is seeing right now. It's not only purchase transactions that are hot, obviously the refinance market as well. So there's a lot going on there, but Kathy's absolutely correct. I did one yesterday, had it locked in, disclosed by noon, and the appraisal was ordered by 2. So it's great. Loan documentation is something that we actually ask for during the pre-approval process. So we're not waiting till they go under contract. We're asking for pay stubs, W-2s, copies of their driver's license, anything that we need. We know that the underwriter is going to require with our experience. We get a very complete file, even like I said, during the pre-approval process for submission to the underwriter. With the pandemic, of course, we are verifying income all the way up to closing. So that means we may ask for a pay stub, their most recent, a few days right before. So we're making sure that there's no hiccups in their income flow. So let's see.
Ladies, can I ask you a question about that? What are you doing if you have 2 buyers who are both self-employed, and would you recommend that we get their pre-qualification done like way ahead of time, even before we start taking them out to see things? Because I know that gets a little tricky.
Yeah.
Absolutely. We actually ask for their tax returns up front during the pre-approval process. We will not issue a pre-approval letter on a self-employed client until we have their verified income.
Right.
Okay, and so is there like a process that you have to do with them all the way up to closing? Because I hear you say about the W-2, you look at their last pay statement. So how would you handle someone who's like 2 people who are self-employed, 2 married people purchasing a property that are self-employed? Is there a different process for following their finances all the way up to closing?
There is. So let's talk about that. Let's say they have yet to complete their 2019 tax returns. So we would use 2017 and 2018, but we would require a copy showing their extension for 2019. And we would require a year-to-date profit and loss, not only for 19, but all the way up to year-to-date now for 2020.
Yeah, they're going to have to do a profit and loss and a balance sheet within 30 days of closing to show that they're still stable, with bank statements, business bank statements to back it up.
Yeah, it's a little bit more detailed now, especially with the pandemic with self-employed borrowers, unfortunately, but it doesn't mean we're not doing them. It's just we've got to do a little bit more up front for y'all.
Thank you.
Of course, we also, during the pre-approval process, explain to them how important it is not to open up any new credit card accounts. Don't go out and purchase out a new car. We also ask them, try to keep them engaged, not to take any trips, you know, those types of things that are important. We explain the importance of not depositing cash, as if we can't verify it, then it cannot be used. We ask if there's any job changes that were notified immediately, because those are all things that it can affect our overall pre-approval. Once we've got everything in place, we do issue for the loan approval. And we always remind the buyers, you know, ask us, don't assume, you know, any question that they should have. We're very good about keeping the lines of communication open. And we do throughout the process give you updates as either the buyer's agent or listing agent on the status and the process of the loan. We touched on that closing disclosure, how it's required. The clock starts ticking 3 days prior to.
One thing that I just had an agent that I talked about on that, they didn't want their buyer to sign the closing disclosure because it wasn't 100% correct. Right now during the pandemic and during the volume that we have, they need to sign that. It doesn't mean that they're going to close, that they're going to use those numbers. But if the escrows are off or any numbers are off, to keep the closing on time, they've got to e-sign it, knowing that before closing, things are going to be adjusted. And we explain that, but as a buyer's agent, you need to explain that too. You're going to get preliminary numbers at least 3 days before closing. You'll need to e-sign that through, and then we'll work with the lender and make sure everything's audited and updated before closing.
I will tell you though, with Kathy and I, we are very detailed initially up front, like we pull the actual tax bill. We do the tax prorations. So even if our estimate does go out without the final figures, it's usually pretty close. It may be just having to verify the HOA letter. Sometimes that changes because, you know, initially once completed up front with the community associations exhibit, the seller may not have all the updated information, and that may be reflected on the final, but we usually get pretty close, I would have to say. And there's one additional step that we've started since this rollout, and I think we're going to actually hold on to it, is our e-closing. So we actually send out the day before closing 90% of their closing documents. They'll be electronically signed by the buyer. They can sign as early as 12:01 a.m. They probably not going to do that, but they'll definitely have to do it prior to going to closing that day. And once they do that, a lot of that is going to be the initial upfront disclosures that we need another signature at closing. So that 90% is a lot of fluff. The extra 10% is what they'll actually wet sign with the attorney, but that will cut your closing time frame down. Anywhere from, say, normally an average closing, it might be an hour, hour 15. It might be now 30 minutes. So we're trying to also have you not, you know, kind of get in and out, basically, have everything squared away.
Yes, just information, you know, and most of you know this. I'm sure a lot of these numbers have been updated on rent versus buy, home ownership, taxability. We've got some flyers actually that talk about it a little bit, and trying to get some more. I mean, right now at these rates, it's so smart to purchase versus renting, because rent just keeps going up. Equity growth, you know, in a house. I mean, you can buy a house and, you know, and have 100,000 of equity possibly in a 5-year period. Being a sound investment, and you know all that. Having the pride of home ownership. A lot of the information that this presentation came from, you've got all the websites here, so you can do your own research. At this time, do y'all have any questions? Any other questions?
I just had one little small question. It was, I think I put it in the chat, but it was just in regards to when you mentioned when we have a client and we want a house and maybe it's more than one buyer, we can just give you a call and you'll be able to also verify with that agent just based off of that our client is indeed qualified, right?
Correct.
Okay. Thank you.
Yeah. We won't be able to tell you or the listing agent any exact details about buyers. That's illegal. They're federally protected. but we're able to tell them enough. We've looked at income, we've looked at credit, we've looked at assets. We do it, it's called automated underwriting. A lot of the listing agents that are experienced, they want to know that you've already ran automated underwriting. And the reason they're asking that question is that's really what an underwriter does. Once the assets are in, the income's verified, all the details of the application, the house, the address, everything, we run an automated system, and that tells the underwriter if you can do this loan or not and what documentation you need. So a lot of times up front, Tammy and I have gathered enough that once they go through underwriting, they really don't need to give anything else. We've already gathered it all. We've already audited it all.
I have a question. Who worries about, I remember in class, and we talked a lot about ownership and if it was owned, fee simple, absolute, and etc. Who initiates that conversation? Is that something that once you get to the lender's side and all the, I guess, tax records, I hope I'm saying this right, is formulated, we see how that person has ownership, or is that something that we should ask initially and then kind of move forward from there?
So are you talking about ownership that the buyer will have on title, or the way the house is, like a townhome or a condo? What are you questioning?
I think on title.
So basically yeah, there's a couple of elements to that question. So there's the way that the current owner owns the home, whether it be like rights of survivorship or joint tenants. That's essentially completely irrelevant to you as a buyer's agent. That'll be dealt with by the title company, right? Whether how the current owner or how the new buyers want to take title, that will also be discussed by the closing attorney. And that's just a simple form that can be handled at the closing table. That is not necessarily connected to who the borrower on the loan is, or whether it's one or the other of the spouses or together. Kathy's discussing basically is the property, it's how what ownership type, so to speak, will you have when you become the owner, right? So are you buying a condominium where basically you own the sheetrock and in, or are you buying the home or townhome fee simple, which is essentially you own the ground, you own the structure, you own the roof, you own the windows, you own the ground that the home sits on, that kind of stuff.
Okay.
Yeah, and the key is you can look at a home and go, oh, that's a townhome. That's 2-story, it's attached to the right. Well, it may be a condo. So you've got to know that as an agent. The listing agent should take time to make sure they know ownership with the homeowners association, because if it's a condo, we have to get condo approval. If it's a townhome or single family, we don't have to worry about any of that.
Right.
So it's very, very important. Even though it might look like a townhome, the original developer may have registered it legally as a condo.
Wow.
And another point there is that, first of all, don't rely on the listing agent. They more often than not don't know what the hell the difference is. Okay, so you got to go straight to the HOA and speak with the representative from the HOA to ask these questions a lot of times. Okay, and also, even if you know it's a fee simple townhome, we're starting to see a lot more kind of variances within that. So for example, does the townhome, who covers the roof if it needs a new roof, right? Like I was a part of a fee simple townhome association where the roof was covered. I've also been a part of a fee simple townhome where the roof was not covered. So that's why you got to go straight to the HOA rep and ask those very specific questions on the condominium association or on the community association disclosure, and make sure you're verifying all the information, because half the time the listing agent just copies it from somebody else, and who knows where that information came from.
Okay. Okay.
Any other questions? One thing that I had come up, I just thought about this HELOC, this equity line. I had a client that needed a bridge loan, but they couldn't get one. It's Alabama, and they couldn't get one on their home. Her company did a bridge loan, and that's acceptable. So you can get a bridge loan from a parent, from a grandparent, from the company you work for, to pull the equity out of a house.
That's awesome.
Yeah.
I've never heard of that before.
Yeah, so we actually coordinated
Don't come to Aubrey for a bridge loan now.
We actually had the owner of the company agree to do a bridge loan, making it subject to, and we did a deed and a note. We helped them work it up. So when her house sells in Alabama, they'll get all the equity. If they don't, then her bonus is a percentage of it every time it comes out. We'll start paying it back. And they did it at like a 1% interest rate. So
Wow.
Tammy and I can help. They really wanted her to stay here and buy this house. So Tammy and I have a lot of insight that, once you talk to a client, they're like, oh, well, I can't get a loan because of this. Well, they don't know. They don't really know. And if they get one opinion, and if it's from a bank or a credit union, it's probably not going to be the full opinion because of the lack of knowledge. Or if they're working with a company that's an internet company that has call centers that, not really experienced loan officers, they may not have the ability to do it, or they may just not know and take enough time to really research it. Tammy and I, it may not be the answer they want that day, but we're going to research enough to find out, is there any way we can get them a loan? And if we can't right now, when can we give them a plan?
Love that. And also I want to just throw in one other thought is they can also kind of do this process like almost in reverse. So for example, I'm about to drop off a detailed offer for you guys, which is I have a tenant that owns or that rents a condo town or a rental condo that I own. And I quite honestly am kind of tired of owning it. And I want to make a pitch to her to buy it. Right. I really like her. I'd like to help her, in the next steps of her life. And I kind of did the research on what I think it's worth. Right. I know what type of loan she's probably going to seek. And obviously know what the HOA fees are and the taxes are. And what I'd like to do is at these low rates, I'd like for Tammy and Kathy to run the numbers and say, hey, rather than paying me this in rent, let's figure out a way where you can pay this in a mortgage and you can get what you want and I can get what I want, which is to, take my equity and move it to something different. Does that make sense? So come and find me. I got a deal for you. Okay.
I know where you are. I know how to find you.
I can hear you. All right, let's finish out. What's one thing, Kathy, that we'll do this. Kathy, Tammy, and I will play this game together. Kathy, tell us one thing that we do not currently know about you that would shock us if we did.
Well, you know what I'm going to say.
What's that?
I'm a black belt.
There you go.
Who else is a black belt on this call?
I'm also a black belt. You guys want to see something cool?
We do. I don't have my picture. I forgot to pull it. I'll have to send it later.
All right, hang on.
So if you ever need somebody to kick
studied,
someone's butt, invite them forward. I said, if you ever need.
Over 30 years ago, I studied with Kathy's husband, karate. Hang on, we'll get this working in just a second. While we're doing this, Tammy, tell us one thing we would not know about you that would shock us if we did.
I'm scared of you and Kathy.
No,
I do not
you know that's a lie.
Let's see. I'm addicted to Orange Theory Fitness. We can start with that. I don't have a black belt, but I do love Orange Theory.
I've gone to the gym with you, and I quit long before you quit. So
I've been doing it just a little bit longer than you have.
Yeah, exactly.
It's frozen. Oh, there he goes.
There he is.
Can you see it?
No, I can't.
All right, hang on. This will be worth the wait. I promise. I promise. I certainly hope I can show this.
This will show you how disciplined Bill was as a kid.
Yeah. Oh my goodness, what's going on with this thing?
It says you started the sharing.
All right, can you see it now?
No. Still says you're starting it.
All right. I'm going to show you guys a little different way, okay? It's worth the wait, y'all. It's worth the wait.
Oh, here it goes. Where is it?
Thinking about it.
Can you guys see that?
A blurred something.
Now?
Nope.
You can't
there
see
you
that?
go.
There it is.
Check it out.
You
Love it.
can't tell it's a flying kick. He's actually, isn't it a flying kick?
See, that's me and Joe Corley 31 years ago.
Isn't he cute?
Oh my gosh. No way.
Yeah. Here's the other one. See that?
Not seeing it right now.
Look at my picture.
Can't see it.
You can't see that?
No. Now you can't see. He's flying in the air, y'all. Isn't that cool?
I love it.
Tawantis, we have some fun around here.
Oh my gosh.
Isn't
I
that
love
cool? He's a bad, I'm not gonna say that. He's a great coach and a great black belt. There you go.
That's right. So you guys, first of
Stop
all,
it.
Tammy and Kathy, thank you so much for organizing this presentation. Thank you for popping in when we had to reschedule. I really appreciate your time today. Please remember that these two lovely ladies in Shelter Mortgage would love an opportunity to help you and your buyers and to continue to teach you all about the ever-changing mortgage industry, and give them a shot. They just did a purchase for me about a year ago. It was a wonderful experience, and they put up with my, I'll get to that. I'll get to that. Okay. So thank you so much. Any
Thank you
other
very
closing
much.
comments?
Thank you.
Nope.
It's very
Hey,
helpful.
we're excited for all of y'all. Congratulations that you've taken the right step and in this program. Bill's gonna get you there. Just do what he says.
Absolutely.
Thank
Do
you
what he
guys.
says.
Thank you. All right, everyone, have a wonderful weekend. I just posted the schedule for next week in the announcements WhatsApp group, and y'all go get some business this weekend. Have some fun, rest and relax.
Have a great
Bye.
weekend, y'all.
Hi,
Thank you,
guys.
Mr. Bill.
Bye.